In this episode of the Seatrade Maritime News Podcast, you'll be hearing from Daniel Richards at Maritime Strategies International about the container shipping market outlook for the second half of 2026. Welcome back to the podcast, Daniel.
Hi, Marcus. Good to be back.
Thank you so much for taking the time. Now, container freight markets bounced back in Q2. Could you give an overview of what has happened in the first half of this year?
It's in many respects quite similar to what we saw a few years ago with the initial phases of the sort of Red Sea crisis. So the container market started the year in generally pretty subdued fashion. That obviously was coincident with the liner companies generally returning to being not profitable or only slightly profitable. And that followed on from a relatively weak period for markets at the end of 2025. You did see a bit of an increase in spot freight rates in the run-up to the Lunar New Year in China, but thereafter it seemed that the industry was heading back into a relatively weak period for markets, and that even before supply was expected to ramp up again in 2027 and beyond. Now, in practice, events have conspired to generate a far more profitable market for liner companies, a far more volatile market for beneficial cargo owners and shippers. And the initial catalyst for this was the closure of the Strait of Hormuz. That's clearly not as significant for the container sector as it is for certainly the tanker sector or certainly the gas sectors. But what we saw is with the rise in global bunker prices, you started to see the imposition of bunker surcharges on top of freight rates. That had an initial inflationary impacts on freight rates. You saw freight rates, certainly to the Middle East, begin to surge as you saw the loss of sailing capacity to the region. But I think it's what's happened since then has been what's kind of caught people off guard a little bit, in that bunker surcharges have been added to freight rates, but those should be measured in sort of hundreds of dollars. But what you've seen is, compared to the situation before the war in Iran, Asia-Europe freight rates then were around sort of $2,500 per FEU. Those have gone up to around $5,000 per FEU now. Rates on the Asia to US West Coast trade that don't go anywhere near the Middle East, those vessels at least, those have gone from around $2,000 to $2,500 to above $6,000 per FEU. So it's been a far more explosive response in markets than many would have expected. And there isn't really one single driver. There's evidence clearly that the demand side of the industry is helping. Demand has held up really well so far this year. So again, continuing growth of around 5% year over year. Only really some of the Middle East trades have seen a notable negative impact so far this year. What you've also seen is the vessels have slowed down a bit as a result of the increase in bunker prices. That takes effective capacity out of the market. It's also likely that the loss of access to sort of the transshipment hubs in the UAE, so Jebel Ali and Khalifa, that's possibly having some ripple effects on the wider efficiency of containerized supply chains. And as those become less efficient, that takes supply out of the market. There's also likely on the demand side that there's been some sort of front loading of cargoes. Now, we can't tell how much this is yet. You can't really tell if you're front loading until you've got the subsequent slowdown to prove that things were being brought forward. But it is likely that shippers were bringing goods in ahead of anticipated higher bunker surcharges, certainly those moving on contracts. It's possible that in the US there was some front loading ahead of the tariff regime changing in July, although in practice tariffs haven't really changed much at all from where they were even before the Supreme Court judgment was handed down. What we're also seeing, though, is it's possible that goods are being brought ahead of expected rises to input costs. So if we look at the containers arriving in the US in Q2, where those return to annual growth after a quite weak period, you saw a big increase in imports of things like plastic. So it's possible that people are anticipating that with higher energy prices, energy-intensive goods, the cost of those are going to go up. So people are trying to front load ahead of that disruption. So it's been a real kind of cocktail of different market drivers, on top, added to which most recently has been high port congestion. So that has sort of spread out from the kind of the South Asian hubs to Southeast Asia, where up to now where it's really Shanghai that's seeing particularly significant port congestion and port waiting time. So again, it's a pattern where events kind of happen, containerized supply chains get disrupted, and it's just a market that's far more responsive to these kinds of forms of disruption and loss of supply compared to where we were in the pre-pandemic years. And I think that this has been the sort of the third instance of that explosive responsive freight rates to events following the COVID-19 pandemic and then the Red Sea crisis a few years ago.
You mentioned that sort of pattern you've seen in sort of previous crises. In those cases, the freight rates remained high for quite a significant length of time. Would you see that happening in the second half of this year, or will things start to come off again?
So in recent weeks, there has been some evidence of spot freight rates beginning to weaken, certainly on the Trans-Pacific, the Asia sort of into the West Coast trades. I think for the moment, they're not likely to collapse, perhaps partly simply because the bunker surcharges are going to remain relatively elevated. It seems that for the moment, oil prices are going to remain higher than they were before the Iran war kicked off. And for the moment, we are relatively optimistic about the demand side. It remains to be seen if there has been front loading. But I think a big theme of certainly the analytical reports that we're putting out to clients, a theme we're highlighting in those is that the big sort of demand side driver has been the cost competitiveness of Chinese exporters, the inability of Chinese domestic demand to absorb all the goods that their factories are producing. And that's effectively leading almost to a positive supply shock to kind of the global goods industry or manufactured goods industry. So for the moment, we don't see that dynamic as particularly changing. There are rumblings around protectionism, this idea of a China shock 2.0, where perhaps down the line, economies beyond the US will begin to look at this kind of flood of Chinese exports a bit more negatively. But for the moment, provided the world economy can remain relatively insulated to what's going on in oil markets in the Middle East, then we think the demand side of the industry should continue to perform pretty well, but it will be a slower pace of growth likely than we saw in the first half of the year. We're also, for the moment, at least for the remainder of 2026, the supply side of the industry is going to be relatively manageable. So fleet growth in the first half of the year was around 5% year over year. That's still not nothing, but it's in line with growth in demand. In global container trade growth, again, was around 5% year over year. The second half of 2026, you're going to start to see deliveries ramp up a bit. But overall, it's not going to be yet this expected sort of flood of new capacity, but that will arrive in 2027 and beyond. So we think that freight rates probably have peaked, barring other unforeseen events, but we're not expecting a collapse in the near term.
Okay. And you mentioned there on the supply side, when we were talking 6 months ago, we were talking about the potential for a return to the Red Sea, but in Adam's opening comments there, it sounds like you're now not expecting that to happen given recent events in Saudi and Yemen.
I mean, actually, what we had even seen prior to the events of the past week or so was actually there had been a bit of a gradual ramp up in liner companies announcing returns to the Red Sea. So CMA CGM have been running some services back through the Red Sea for a while now. What you saw in July is that Maersk announced really 3 kind of changes to their services. So one of their Asia-Europe loops with Hapag-Lloyd, they announced was going back through the Red Sea. They announced that a Middle East, India to US East Coast route was going back through. And similarly, a sort of Middle East, Mediterranean, West Africa service was also going to go back through. Those ships have continued to make those transits. There's a few vessels with their AIS company turned off who should be making those transits at the moment. I guess we'll see what's happened since the recent Houthi announcements, whether that does continue. But yeah, I think in terms of a wider range of carriers, again, the events of the past week where the Houthis are now talking about replicating the Iran's approach in the Strait of Hormuz, it's unlikely that other carriers are going to be rushing to announce returns. But there had been some movement towards that even since the start of the war in Iran.
Okay, but that will act as a constraint on the supply side. How are things looking if we look at the charter market?
The charter market continues to fare incredibly well. It remains very much a vessel owner's market, not a liner company charterer's market. TC rates have remained broadly at a very, very elevated level since they kind of rose in the first half of 2024. And if anything, they continue to strengthen. So not big changes, not all benchmarks we're tracking at once, but rates do just continue to inch upwards. And it's fundamentally it's a story really of continuity where liner companies still are trying to add ships to their networks, in particular charter market size ships of sort of below 8,000 TEU, and they just don't have many to choose from at the moment. This is, again, a longer term story of NSC and other liner companies buying so many ships out of the market, relatively limited fleet growth in some of those segments. So for the moment, if you're trying to fix a ship out to a liner company, you remain in a very strong bargaining position. And that doesn't seem likely to change at all for the remainder of 2026. To the extent we do see a normalization or a weakening in those markets, that's going to take really some time to play out. So even if we do see a weakening freight rate outlook sooner rather than later, it is likely to remain the case that the charter market and then also second-hand values will respond with more of a lag.
Okay, so pretty good news if you're a tonnage owner and supplier to the market. And just also one more thing in terms of the vessels themselves, and that's we've seen this continued ordering of new buildings. When does this actually come back to sort of bite the sector?
So the ordering that's happening now isn't really going to be the problem. I mean, the ships that you've seen around sort of nearly 1.9 million TEU of vessels ordered so far this year, compared to 5 million in last year as a whole. Those ships have shifted towards smaller vessels in generally. But we do think that realistically from 2027, 2028, the wave of ships that we're expecting to see hit the water, those are going to have a negative impact on overall market balances. And I think the ordering you've seen so far this year has been interesting. I think that the volume of orders of smaller to mid-sized ships that we've seen placed has been more than I think people had anticipated. We're seeing a lot of Greek owners kind of move into this space. We're seeing a lot of quite obscure Chinese owners placing our orders at yards people hadn't really heard of before. So there is a bit of a rush to kind of get this volume of tonnage on the water. And ultimately, I think if you look at our measures for market balances, so in our sort of online platforms, in our quarterly analytical reports, we're tracking how this evolution of market balances looks for different subsegments of the fleet. And what we're seeing is that this increase in ordering for the smaller to mid-sized ships, it is generally speaking still consistent with the aging profile of that fleet. It's a very different picture for the large ships where there's no elderly fleet to scrap. But I think what we're going to be trying to do for clients in our upcoming reports and model updates is really try to tease out how do you balance this very lopsided order book and fleet profile dynamic, and really how do you find homes for all the large ships that we're coming to see online. And like you saw in 2015-16, is there going to be a point where there's a pinch point in the container ship cascade where the volume of larger ships is too much for smaller trade lanes to absorb? So it's a really interesting picture. On top of this, you have all the dynamics around the energy transition and the potential for liner companies to slow their fleets down. But the big picture is, although the industry clearly is quite responsive to episodes of crisis, and that can lead to sort of temporary kind of boost profitability, the big picture is that the order book is very large at nearly 40% of the fleet now, and we think that will take a toll on markets as we move into next year and beyond.
40% of the fleet, that's a pretty big number. It'll be very interesting to see how that plays out in the years ahead. That's all we have time for today on the Seatrade Maritime News Podcast. Thank you for listening, and we look forward to joining you on the next episode.